In this video, we will be talking about specific intangible assets such as patent, copyright, trademark, franchise, and customer list. This is the second part of the Intangible Asset series. If you haven't watched part 1 yet, please check the link in the description and support this channel by clicking the subscribe button down below. Let's go! Let's start with a patent. A patent is an exclusive right granted by the government to an inventor, enabling the grantee to control the manufacture, sale, or other use of the invention for a specified period of time. Under the Intellectual Property Code of the Philippines, the legal life of a patent shall be 20 years from the filing date of the application. Therefore, the patent is amortized over its useful life or 20 years, whichever is shorter. In some cases, an entity may acquire a competitive patent to protect the original patent. If this happens, the cost of the competitive patent is simply amortized over the remaining life of the old patent. We must take note, however, that under the law, a patent cannot be renewed, but its life can be extended by a related patent. In this case, the cost of both the related patent as well as the unamortized cost of the old patent shall now be amortized over the extended life. How about copyright? Copyright is an exclusive right granted by the government to the author, composer, or an artist, enabling him to publish, sell, or otherwise benefit from his literary, musical, or artistic work. Under the law, protection for copyright shall last during the lifetime of the author and for 50 years after his death. The copyright is amortized on its useful life. However, it is acceptable in practice to directly write off the cost of the copyright against the revenue of the first printing. The principles governing the cost of an acquired copyright, as discussed in the first video, will still apply. For an internally developed copyright, however, the cost consists of all the expenses incurred in the production of the work, including those required to establish the right. Our next intangible would be trademark. The legal life of trademark is 10 years, renewable for periods of 10 years each. If the trademark is internally developed, the cost includes expenses incurred in establishing and securing the trademark. This includes the design cost, filing fee, as well as registration fees. It is important to note that since trademark has a renewable life, it is not amortized but simply tested for impairment. Now, a question arises as to the present value computation for impairment. The present value can be obtained by simply dividing the annual cash flow by the appropriate discount rate. For instance, an entity acquired a trademark which has a carrying amount of 3 million and a remaining legal life of 7 years. By year end, indications suggest that trademark is expected to generate cash flows of 250,000 per year. If the entity expects to routinely renew the trademark in the future, this means that we only test the trademark for impairment. We do this by comparing the carrying amount at 3 million against the present value of future cash flows at 2,500,000. That is 250,000 divided by the discount rate of 10%. Therefore, our impairment loss would be 500,000. Now, we look at franchises. Accounting for franchise involves numerous considerations. One must particularly refer to PFRS 15 entitled Revenue from Contracts with Customers. In this video, however, we'll only cover the general concepts concerning franchise. Under a franchise agreement, a party called the franchisor grants certain rights to another party called the franchisee over matters such as business knowledge and processes. This agreement may be among private entities, as in the case of Jollibee, McDonald's, or 7-Eleven, and other well-known brands. Or it may be between the government and a private entity, such as the franchise for the use of public water for inter-island shipping, or public land for telephone and electric lines. The cost of franchise falls into two categories, the initial and the continuing franchise fee. The initial franchise fee includes the lump sum payment for the acquisition of the franchise, together with the related expenses incurred. This initial payment, however, may be in the form of a non-interest-bearing note. In this case, we simply obtain the sum of the down payment and the present value of future cash payments using the appropriate discount rate. Contrastingly, if the agreement requires the franchisee to make the periodic payment to the franchisor, the payment is expensed outright. Lastly, we have customer lists. A customer list is a customer database containing the name, contract information, order history, and other statistics regarding a customer. The cost of an acquired customer list includes the purchase price plus the cost directly attributable to the acquisition. Meanwhile, paragraph 63 of PAS 38 explicitly states that internally generated customer list shall not be recognized as an intangible asset and therefore expensed.